Welcome to IVoT Ion Investing, where our experts look at the economy, the market, and particular companies from a long-term fundamental perspective. IVoT Financial Training Inc. is a company committed to making financial mastery accessible to everyone. To learn more, go to IVoT.academy. On today's show, our IVoT financial advisor Ed Butowksy and IVoT market analyst Andrew Tang discuss client concerns around consumer confidence and the government shutdown, and why historical precedent suggests the market will not be negatively impacted. Then, IVoT analyst Emile Westergaard takes a look at the two cheapest stocks in our current forecaster library, Pfizer and AT&T. Both of them have some issues, but may still be interesting, particularly if you like a high dividend yield. Let's get started.
Okay, hi Ed, hi Andrew, welcome back this week, and I'm looking forward to our discussion on the various topics for today, which include what you're talking about with your clients as financial advisors, and then Andrew's market update, and I will be giving a third quarter preview of some of the companies that we've talked about over the last couple of months. I think, starting out with just what your clients are interested in, and also maybe relating that to the market. I'm just curious because there's been so much news lately. First of all, consumer confidence continues to degrade. And also we have the government shutdown coming in. Maybe I'll start with you, Ed. Is that making your clients nervous? And if so, what is your messaging to them?
Yeah, the idea of the government shutdown is just starting to get into the bloodstream and the thought process of my clients. But I will tell you that history is our guide. There's going to be no negative impact from the government shutdown at all to the stock market. In fact, in the last number of government shutdowns, the stock market has actually risen as a result. Not so much as a result, but after the government shutdown was over, the stock market has gone higher. So I do not forecast anything negative. The only negative I would say is that there's going to be difficulty collecting data on inflation and unemployment because of the government shutdown. But from the standpoint of earnings and returns, I don't see there being any impact. From a consumer sentiment standpoint, there's a big difference between consumer sentiment and investor sentiment. And people need to understand that consumer sentiment is, how the consumer feels. Investor sentiment is something very, very different. And there's a lot we can learn from the investor sentiment as well. So, investor sentiment.
So let me ask you though, just I know you're on the first one for a moment. I'm sorry, but on the government just for a moment, because I know what you're saying about kind of the historical, precedent on government shutdowns and what that's done to the market. But it seems to me that this administration has been looking to reduce the level of government in the country pretty significantly. A lot of people working for the government are, losing their jobs. I have friends working for the government who feel their jobs are very at risk month to month even. And I guess I'm wondering, it seems to me that this is somewhat of a purposeful shutdown to give them more opportunity to reduce the government payrolls. And in that case, does that begin? I mean, the government is the largest employer in the U.S., I would assume. Doesn't that begin to have some kind of an economic impact or no?
Oh boy, you sound like a conspiracy theorist. I don't believe that the government is going to be shut down to reduce the amount of payroll that's out there. I don't also believe that there's that much economic activity from government employees. So if they miss a paycheck every, a month or two, is going to have a major impact on consumer spending. I just don't see that being the case. And I also don't think there's going to be a prolonged government shutdown at all.
Andrew, any thoughts on your end? Or
Echoing what Ed is saying is that there's a huge divergence between investor sentiment and consumer sentiment. And largely the consumer sentiment that is, stubbornly sticking to these low levels. If you look back in the 5 years, it is hitting almost as low as the July time when the Federal Reserve was creating a restrictive environment, right? So we are similar to that area right now. And most of the reasons why consumer confidence are low is because of sticky inflation, um, high borrowing cost, and also the, labor market jitters. They are not sure, if they are going to have the job security. That's very important, and that is coming across the board. So not only government employees, but also private sector as well. One sector that is going to be largely impacted by the advances in AI and technology and innovation and automation is the financial sector. So big banks and financial firms, they employ lots of employees to run models, to also run risk and the maintenance of things. Largely, a huge percentage of that it's going to be able to cut down through automation software and AI. And, across the board, you see what Department of Government Efficiency have trying to do. They are also, that particular sector, they're also being introduced with these technologies and innovative tools. So it's really across both public and private sectors that we're seeing this job insecurity. And again, the prices are still sticky. Inflation is tamed, I would say even under control, but the prices are not rolling back to several years ago. Whatever is raised is raised. Same thing with hiring employee. You give somebody a raise, going forward, you're not going to be able to reduce their salary just because, things have changed. And going back to your question, government employees account for only about 15% of the total payroll altogether. And so putting all this together, the consumer sentiment is still a reflection of the uncertainty that is put in front of them because they don't know about their job security. If you are employed in the high tech AI area, of course, you're going to be sought after. But for the general public, especially for the entry level positions, clerical positions, not top management, you will be under the gun. And I completely understand how that level of uncertainty can linger around.
well, I guess maybe that can segue into what that means for the markets, which I think you both seem pretty sanguine about any impact from either of these issues on the market. Though I wonder again if the job losses are kind of broad swath, meaning they're also hitting white collar and kind of upper end jobs. When does that begin to have an impact on the economy, if at all?
It's already happening. As a matter of fact, the most job losses is the white collar. The white collar entry level positions, they were the most impacted. And going back to the market sentiment, clients are worrying about what they read in headlines because some headlines come across that, hey, this AI bubble is going to pop and everything is going to retrace at least 50% or so on and so forth. So you hear this from clients and you see it across the headlines. You hear it on some news reporting. But I would say this is that uh, the AI race and the AI build out, it's not completed yet. And what Jensen Huang, the CEO of NVIDIA, came out and said, and the deal that they put together reinforces this growth of demand uh, of the infrastructure that needs to build out in terms of AI. I'm not going to get into too technical, but there is AGI and then there's ASI. And then there is the applicable artificial intelligence. So real world intelligence is when we can use it on our phones, when we can use it with Alexa, to basically help us schedule things, read our emails, and basically empower us to basically be more productive and efficient. And these are the productivity tools. ASI for super intelligence is when we reach a level of superhuman intelligence that can solve really complex problem.
Right.
AGI for general intelligence is when the AI can basically make decisions and think for themselves. Okay, so
Yeah.
there's three different things. So the
That's for
big money firms,
that's for the dystopian kind
yeah.
of
So,
come
so
in
the
from.
big money firms, they are going after AGI and ASI. And in my opinion, the ASI will be here before AGI.
Yeah.
But on the real life application of artificial intelligence, it's already here. It's already in the works. So you're going to continue to see layoffs. It's going to happen across the board. But on the same token, it is true that there is the other side of things, is that there are still a lot of jobs creating to basically to bring about this change, to power, to fuel this change, right? And so there's a lot of jobs that are being shifted, and we can see retailers, for example, the most recent news is probably Starbucks, right? When we talk about Main Street, Starbucks just came out that they're going to close stores and they're going to cut employees. When they reopen, what do you think is going to happen? Most likely, I mean, take an example from their competitor, Luckin, copycat of Starbucks, but it's a 100% app only, and all they have is just barista behind the scenes, and people just come in and pick up their goods. Very similar to the kiosks that appeared in McDonald's at first several years ago. So that's what we're seeing: automations, hardware, software, AI enhance to increase productivity. It's continue to happen. So job losses and job shifting, this is going to be a matter of fact, and it's not going to stop anytime soon.
So
Hey,
Emile,
I'm
you had
curious.
asked the question.
Go
Emile,
ahead.
you had asked the question about the valuation on the stock market and what we're telling our clients. And
Yeah.
I'm kind of talking out both sides of my mouth because on one hand, I'm saying that the stock market is incredibly overvalued. But at the same time, we're still seeing earnings forecasts come in that are ratcheting higher. So we could see the market go higher from here, and the stock market can stay overvalued for months and months, even years and years. And I think that's what we're going to be in is a long-term overvaluation. But we're about 35% overvalued right now. And if you took the Mag 7 out, we're still overvalued. So it's not just the Mag 7 that is making the stock market overvalued. It's the overall expectation of stocks being way ahead of their earnings.
Yeah,
Well,
it's
that's an oh, sorry. Well, I'll just pipe in from an IVOT perspective on that. So IVOT, like any stock that we look at with our forecasters, and we'll be doing that in a couple of minutes, is always cash flow based, right? So to your point, Ed, there is a premium in the stock in the S&P 500 right now relative to cash flow from an IVOT perspective, which I can tell you we're very specific on this. The baseline value based on the current cash flow from the 500 is $551, and the index is currently at 608. So it's about a 9% overprice based on how we do the math. That being said, from an IVOT perspective, you own the future, not the present. So that's a current multiple. So it depends ultimately from our perspective. The market could even be cheap if we're running into some significant earnings growth from AI, let's say in the S&P 500. That could actually prove to make the market cheap right now, even though it's slightly overpriced relative to current earnings and cash flow. So, I mean, that's
yeah,
just
I
it's
yeah,
just my.
I agree with that because when we have this S curve or J curve of this increase in productivity that's going to enhance the company's bottom line and top line, we are going to continue to see earning surprise to the upside. Now, of course, any kind of a build out of innovation, it's going to require a lot of capital, and there are going to be successes and there are going to be misses. Trust me on that. There's going to be a lot of companies that's going to go out of business because the concept won't work. And many of the companies are going to lose, or retrace from their, astronomical valuations. But overall, the change that is broadly going to bring about, it's about efficiency and doing more with less. And that's why currently the valuation looking forward with all that's going on, it is still, in its infancy stage. And so the enterprise growth of AI, it is becoming reality, and we can see that in the earnings surprises from the companies.
Okay, well, that's great. I think we should move on to our stock segment of the program. And so we'll be back in a minute. All right, welcome back, everyone. So today we're doing a third quarter preview, and the way I've arranged this today is we're going to look at 4 of our companies. 2 of them look the cheapest relative to cash flow because, again, we are fundamental investors here at IVoT. So the question is, the 2 we're looking at are Pfizer and AT&T. Now, Pfizer has a current baseline cash flow value according to the IVoT method of $90, and it's currently trading at $23. Now that obviously looks almost, how could that be? How could this company that has a cash flow stream now of roughly $90, the way we calculate it, could be trading at 23? Well, Pfizer, there's a pretty decent explanation for this, which is roughly half of their sales are going off patent in the next 3 years. So on that level, you can understand why investors might be nervous owning Pfizer shares, though I know, Ed, you like dividends for your clients, and right now Pfizer is giving out about a 7% dividend to shareholders. So that's one element of why you would want to own it at $23. The other thing is, if you arguably say that half their revenues are going off patent, that would, the way we calculate it, get you down to about a $45 value for the company, just assuming that all goes off patent, and you're buying it for 23. So actually would still look very cheap. And you're getting a pipeline. So obviously we don't have, the resources right here. I used to be a healthcare fund manager on Wall Street. I had PhD biotech analysts working for me doing evaluations of the pipelines of all these big drug companies. I don't have those resources right now, though I hope to have them at some point here in the future with IVoT. We'll bring on a lot of young people to do that work. But just on a risk reward, if you're paying $23 for something with $45 in sustained cash flow and a pipeline of product that they bought, which you assume maybe some of those things will kick in, Pfizer looks kind of interesting. Any thoughts on that, Ed? I mean, I know you like that one for your clients.
Yeah, I absolutely love it, and also there's a lot of discussion in the biotech world where companies like Pfizer go and buy biotech companies and then put them into their arsenal of or their inventory of drug companies. And I really like the idea of a 7% dividend while you get some growth. So I'm a big buyer of Pfizer right now.
Yeah, well, I think it is interesting for sure. And to your point about buying biotech, well, they had a cash windfall during COVID with their vaccine and their therapeutic, and they spent that money buying biotech assets. So that's what we hopefully they did some good buys in there, and we have stuff coming in the pipeline that would be of interest to again, to investors. All right, the second cheapo stock we're going to mention today is AT&T. Now AT&T is trading at $28 a share. It's had a good year. It's up 23% year to date. It's got a 4% dividend yield. The cash flow value, according to the way we analyze AT&T, is $128 a share. Now, that's kind of astounding, really, because there is no patent cliffs there. They have a pretty steady business. It's not growing, it's not exciting these days, but it's pretty stable. And so, again, I don't really have too much to say about it, except we have done a show more recently, and we'll do some more detailed shows coming up. I think we'll probably do a deeper dive show this fall. We'll start doing some of those on some of the companies, and AT&T would be interesting. But any thoughts from you all on AT&T as a portfolio opportunity?
Well, that's another company that I started buying back when it was at 15 and 16, and I was getting a 7% yield on it. And I like slow and steady. I like boring. I like just them compounding their money. And right now, there seems to be a big battle between them and Verizon and T-Mobile. And AT&T is obviously one of the biggest. And as long as they don't go out and make another silly purchase like they did recently, and then have to sell it off at a loss, they're going to be really a sound investment for a long time to come.
Yeah, and what I'll add to that is AT&T is really viewed as more as a utility company. And so one of the key features of utility company is that they're very, very heavily in debt. And that's how they really raise capital or fund their businesses. And so with the environment of rates coming down, it is beneficial to utility companies. And that falls into AT&T's category as well. Another thing is that, sure, they have very fierce competition with Verizon and also T-Mobile. And T-Mobile has a key features because of their previous agreement with Starlink, if you remember that. And now T-Mobile customers can actually sign up for not too much more, roughly about, I believe, $40 or less more. And you can get this continuation of cellular service. Even if you lose the cell tower, it'll automatically switch to Starlink communications. And so for those who are out in the mountains or out in the hiking or camping or wherever that is away from metropolis or cities, absolutely that is a big plus to have. And you don't need to have a satellite phone for that. And you can just use your existing phones with T-Mobile. So that's something that is giving, their AT&T's competition, an edge here.
But the AT&T subscriber base has been pretty stable and
Yes.
actually growing a bit. So, but I know that's an interesting competitive matter. I know, Andrew, you're our AI guy. I would assume that there's a lot of opportunity in a company like AT&T to use AI across their various product lines, no?
I would look at AT&T as a takeover target.
Interesting.
Yeah.
Who would be a buyer of AT&T?
Listen, I can't say and I can't prove it, all right, but I know Tesla is looking around.
Oh, in Tesla, interesting.
Yeah.
Wow, crazy world, right? That's amazing.
Yeah.
Well, I think that's a good wrap up for today. I think we covered some nice materials, some good companies, some interesting opportunities. And next week we're going to take a look at Nike because they're reporting their quarter in the next couple of days, and Nike's been really struggling as a business. And so it'll be interesting to see if there's any new signs of life there because I think obviously one of the biggest sports brands in the world. Other than that, I appreciate again our weekly sessions here. Thanks, Ed. Again, we're here from IVoT. IVoT is our financial training platform, which we featured in the introduction as well. And there's a link now to actually sign in and start using our platform in the description on the video. So looking forward to seeing you at IVoT and testing out our tools. We didn't actually show any tools today. I guess I didn't do that. But next week with Nike, we'll actually use the forecaster to update on Nike.
Sounds good. Thank you very much, Emile.
Thanks for having me. See you soon.
Thank you for watching IVoT Ion Investing. Please subscribe to our YouTube channel and click on the link in the description to register for early access to the platform opening soon. which includes access to our powerful IVoT forecasters and fundamental investment training.